Again, once again, welcome, Mr. Welcome, Sam. Welcome, Mr. Chavelle, Sfiso. I can see Vivo there. I don't know, Vivo 2015. I don't know who is Vivo. But again, you are welcome. You are welcome. All right. So today I was preparing a little bit more of the indicators. I think we were talking about the indicators last week. So I wanted actually, to proceed with the information about the indicators so that we can look into different indicators and see how we can be able, to use them or to keep on practice bit by bit. You end up, understand the indicator and start actually, trading using the indicator. So the indicator, it's actually the software that is being installed already on your MT4. So on your MT4, there's already indicators. So you just have to know how to use them. Now, the importance of the indicator, some indicators tells you where the market has been gone and where the market has been dropped. Some indicators actually tells you where the market is actually wanna go, or it has a certain habit that says if you see 1, 2, 3, it actually means there's a possibility the market will go this direction, whether bullish direction or bearish direction. So they are all, the idea was when you are using the indicator to get a little bit of idea where the market is going, where else you can follow the market so that you can be able to make a good trade and a good positive trading. So there's a different types of indicators. Last week we touched about the Fibonacci indicator. We have another indicator called Ichimoku indicator. All of these, they have also in a category, which is a different types of category of indicators. So there's a trend indicator, there's a momentum indicator. Those are the different types of indicators that you can get. Okay. So the Fibonacci indicator, maybe we should start with the Fibonacci indicator because we touched it last week. And I feel like it's one of the good indicator to use as the beginners, when you're starting. What it does help you to understand the support and the resistance level. Once you understand the support and the resistance, then it's way much more better to monitor your trades or to actually understand how your trades are going. Because if you understand that that point, that's the point last week the market turned, oh, this point down there, this is the point where the market actually turned last week, then you have an idea to say that if I go with this trade, there's a possibility that it might turn at this point. That's the advantage of understanding the support and the resistance indicator. You can know that, okay, if I open at this level, at this price, last week it turned at, at this level, then let me put a take profit so that once it get to that level, it can take your profit. You keep your profit in your account. So the Fibonacci retracement strategy determines a two price level at which reversal of the pullback, right, may happen, and it is then quickly followed by the retracement per the trend direction, right? Knowing where it reversed and where it pulled back. So this is support and the resistance. The most important price action, if you want to learn how to do it on your own, understand the support and the resistance. And the easiest way to understand the support and the resistance, practice the Fibonacci retracement. So the retracement, it's a popular technical tools that tools for investors to determine the Fibonacci levels at which an upper trend, downtrend is likely rebound of a reverse. The retracement pattern is created using the Fibonacci numbers introduced by the Italian-based mathematicians Leonardo Fibonacci in the 13th century. So it's been there before. So the system of the calculation of Fibonacci numbers has been there since centuries ago. That's where it's been introduced, which doesn't really matter about us, this calculation of numbers. It doesn't mean anything. It doesn't really affect anything in our market, right? But to understand that where the numbers coming from, you can be able to research more about how you, you go with the numbers. The Fibonacci numbers are nothing but a series of natural numbers, beginning with a 0 to 1 and continuing to its infinity. Each number in the series is derived by adding 2 previous numbers. Hence, the numbers formed are 0 plus 1 is equal to 1, like that, which is numbers are not really matters on us. So the Fibonacci ratio or the percentage, the pattern is these numbers. When they computed further, give us a percentage called Fibonacci percentage. This time, each number is divided by its succeeded number at a first. So a second and a third position, this Fibonacci trading percentage are used in the stock markets to predict a support and a resistance level for the extended a trade. So it's all about the support and the resistance. As I said, numbers and the ratios itself, they're not that much. Okay, you can start understanding support and resistance of Fibonacci. Then we come and now understanding the Fibonacci ratio numbers. When they're written in a percentage format, these questions become a 61.8%, 38.2%, 26.6%, and so on. This percentage determines the Fibonacci levels and investors predict the reversal upwards or downwards. So if you draw the Fibonacci on the chart, the percentage numbers that you're going to see, 61.8, 38.2, 23.6, right? So these are levels. These are not percentage that put, but these are levels that the market has been retraced or it has been reversed, right? Again, you can look at the, you can look at the chart, look how the market is going, and you can see that, oh, it's getting to 61.8%. That means there's a possibility that the market can change the direction once this trade get to 61.8, and then it can, whether it breaks on that point, you can decide to put a take profit or a stop loss, or it can break, continue with the trade. Then it get to 38.2. Then you can say, oh, okay, I think it's getting to 38.2. That's another possibility that the market can again turn, or it can again, retrace. So I feel like it's very important, the Fibonacci retracement, to actually everyone, to try and practice, the Fibonacci retracement and the ratios as well. All right. There is no specific formula to determine a retracement level. However, the traders can draw them, the line on a stock chart by identifying the trend and considering the potential price range, a higher or a peak, lower or through, for a specific assets at a support and the resistance level. All right. So the key point here, you can draw the line, the Fibonacci, and these are the percentage that I was talking about: 0, 23, 38, 50, 61. If you look at it, here is the Fibonacci line. You draw it from the highest of the stock or trade to the lowest, just one line. But remember, depending with the trend, right? If the trend, it's a downward, start from top to down. If it trend, it's upwards, start from the bottom to top. So depending with the trend. And if you look at it, this line, it actually forms, after you draw this line, it actually opens these boxes. And these are resistance, support, and the resistance level in a percentage form. So you can see, if you enter a trade here, it's going all the way up here. It's very easy to put a take profit, because the next position, possible position, this trade to 10, it's on a 38.2%. Again, same thing, 50%. Again, above, same thing, 61.8%. So you can make a decision to say that, okay, once it gets to 38.2%, I'm closing my trade and wait for it to see where it's going to go. Is it going to go down or continue with the trade? When you start continuing with the trade, you can enter again, saying you're going to close at a 50%. Okay. Any questions so far? So far, so good with the Fibonacci. Okay, the most used ratio included 23.6%, 38.2%, and 61.8%. Why they're not putting that 50% is because of it's in a base level. So once they don't add the base percentage level on the middle, they add 23, 38 to 61. That is why, again, you don't see zero, you're not seeing 100%. The Fibonacci retracement strategy, it's more common in the stock markets, whether it is an upper trend or downtrend. The nature of financial market, it's such that each tradable assets rebounds on a reverse upon reaching a certain retracement level. It means there is a higher probability of a stock regaining at its peak or top, right? There's a higher probability the trade that you are trading, it might trade at this level. So imagine knowing that this trade, there's a higher possibility to turn at this level. You know, that's the good part about it. That's the good nature part about it, right? After identifying the Fibonacci levels, traders can decide whether to buy or sell that stock. For example, if a downtrend start to go up, they can analyze the future market trend using the retracement level and decide when to sell an asset to get the best value. Okay, the Fibonacci retracement strategy prepares the traders for the upcoming fluctuation in the market and allows them to trade safety in unpredictable markets. Okay. So the Fibonacci retracement is a technical trading chart pattern predicting the level at which levels of a pullback may occur, and it is then quickly followed by the retracement per the trading direction. How to use the Fibonacci retracement? It's easy to use the two. One should first identify the market trend and then determine a potential price range, a highest point and the lowest point, which is a peak and the trough of an asset at a support and a resistance level. Next, they need to drag the point from the high swing to the lower swing of existing trend. Now they can predict the upper trend or a downtrend using the Fibonacci retracement ratios. All right. Any questions for Fibonacci before we get to Ichimoku indicator? Questions for Fibonacci? All right, cool. So now let's try to install the Fibonacci on a different trend. This is the upper trend, it's not a downtrend, right? Then there's a downtrend and there's an upper trend. So we're going to try to see it in a different way. This is the lowest point of the market. This is the highest point of the market. Again, when we are analyzing, we go to a little bit of a bigger time frame. So we go on a H4, not 1 hour, not 30 minutes, not 15 minutes, not 5 minutes, not a minute. We go 4 hour, maybe on a daily, so that we can be able to see the whole trend of the market, where it has been going, where exactly, you know, it's actually going at particular time. Okay, so we go on a 4 hour, because we want to also stretch it longer in a way that when we are trading, then we run out of money and we cannot be able to carry on with that trade. So you go insert indicators written there, or if you go scroll, you see Fibonacci retracement, right? You click on it. This is the lowest point. Drag the line to the highest point. Here we go. All right, cool. Okay, I want to see it in a bigger time frame, but it's not giving me data. All right. So we can see 61% level, this is where actually the retracement has been done. The market was going all the way up. It fell actually to continue. You know, it comes all the way back. And then from this side, jumped. This is jumped. This is actually a gap. It gapped from this side all the way to this level. This is a Brent oil and continue going. Again, when it comes to 38%, look at what happened on the 50%. Not much really activities happen on 50% than on a 68 or on 38. Look at on a 38. Couple of retracement at that particular level and then go on. So if you are here, you are buying, you can know that the next possible position of turning is this side. So you can easily put your take profit at this side. Now, when you are here, you are buying, but you want to put a stop loss. You can easily put your stop loss maybe somewhere under there, right? To say that if it comes this side, it must hit my stop loss. But if it goes all the way up, this is my first take profit. So look at it if you look at on a little bit smaller time frame. All right, little bit of smaller time frame, again, shows momentum, retrace at the particular time, goes all the way up, retrace at 38, keep on momentum going, right? So at this level, you could have easily identified that this trade is not going back because it had to break and, you know, reverse, go all the way back, but it didn't break. It's been playing around at the same position. And then even if you close at this part, you open here, you close at this part, you close, you take your profit. The market didn't really do any movement. There was no much movement that can bring money at this particular time because you can see it come back until to this side again, right? Then you can enter until you see the confirmation candlestick, something like a hammer. Enter again, another buy. Here's another take profit on the Fibonacci. So that's a good thing of using Fibonacci. It does tells you where. Here, look at where the market it is right now, right? Again, you can make a decision to say that, okay, according to the way I'm thinking of Brent oil, it has pushed it all the way to 95.49 a barrel. I think it will start dropping. You can enter your sell, then the next possible position that it will do any type of a movement, it's only 23.6%. Easy like that. Very easy strategy, very easy to trade with the Fibonacci. Okay, so let's look at a downtrend. Okay, on a bigger time frame, this one looks like it's an upper trend. Wanna see? Okay, this is let me look at. And Nasdaq is continuing falling all the way. This is the next possible line. So let's say on a Nasdaq, right? I'm removing all the lines that I put here because I want to see that even if right now you want to enter Nasdaq and you want to use the Fibonacci, you go to the bigger time frame, insert indicator, or you go on a Fibonacci retracement from the highest point. This is the highest point that I'm thinking. Pulls to the lowest point. Again, it's almost close to 23.6%, almost close to the point where it can retrace. It can hit this point. Let me see what's the time. Okay, there's 4 minutes so that the new candlestick can be formed in any time frame that we'll have. So it can push. This is the level where it needs to come. And if you were trading, you were selling, this is the levels that you could have put as a resistance. Look where it touches the Fibonacci lines. Same position, right? Again, let's go maybe 1 hour. Trying to check it out on an hour, same thing. Dropping, this is the highest possible position that it might come and change maybe direction, or it might break also this level, go or continue all the way down. So if you put a take profit here, you know that your first take profit it's gonna hit. Once it's coming maybe this side, if you are smart, let's say for example, this was your take profit. Let me show you guys one thing. Okay, let's say this level, we're putting it as a take profit, that once it hit to our Fibonacci, then we're good, we out. First take profit. Second, and then at this level on a 38.2, you put it as stop loss, right? You enter on a 50% position, a sell comes in, it breaks that position that you were thinking in route 10, forms another candlestick, continue training. So here's the trick that you do to lock always the profit. When you see the trade is closed like this, to get to the level that you put a take profit, you modify. So you click on a trade, you click on a modify. When you modify, you move the take profit a little bit further to another next possible position of 10, right? When you move the take profit, so when you modify, this is the number that you put. When you click modify, it will ask you to put the number, right? You put this number 10931, and then it will show you modify. You click modify, it will change. The take profit has moved a little bit down because you know anytime it might hit this possible position. Now, what you do again, you modify again a stop loss. You pushes the stop loss a little bit further down, right? What happened now? You have locked the profit from here to here. Everything that you make from top to this side, it's yours no matter what. So you can go to store, you can go to shop, you can go to do whatever that you do. If the market goes all the way reverse, it will hit this stop loss, close the profit, now close the trade automatically. It will close with this profit. This is the profit that it will close with, right? If the market continues going this side, this is your target that it will hit as a take profit. So you're good. You come back from the shop, so you come back from work, it didn't reach to this side, but it's somewhere around in this level. Again, you modify, you continue moving, continue move the take profit and the stop loss a little bit down. Then after that, you can go sleep. You can say that, no, hallelujah, it's done, I can go sleep. Yeah. So that's about the Fibonacci retracement. Any questions? Any questions so far? So far, so good. All right. Okay. All right. Okay. So guys, today we have a very short presentation. We'll be closing anytime soon, you know, our Zoom. So I'm not going to take a lot of time, your time today. Okay. FX Hunter, thank you. Amazing stuff. Thank you. The second, indicator that I wanted us just to have a look on it is called the Ichimoku indicator. The Ichimoku indicator is made up of two different components, the conversion and the baseline. Those look like a moving average on your charts, but they are not, as we will see. The Ichimoku cloud, the cloud is the most popular aspect of the indicator because it stands out the most. Okay, because it's the one that actually you can see it when you put it on a chart. Ichimoku was created and revealed in 1968 in a manner unlike most other technical indicators and a chart. All right, so this is how the Ichimoku show. This is the cloud that has been saying cloud. And then this is conversion base. This line, it's a conversion base. All right, now let's try to find out what each of these lines means. Kijuni-sen, a blue line, also called the standard line or a baseline. This is calculated by the averaging the highest high and the lowest low for the past 26 periods. Tekensing, it's a red line. This is also known as the turning line, as derived by the averaging the highest high and the lowest low for the past 9 periods. Chikuo span, it's a green line. This is called a lagging line. It is also today's closing price plotted by the 26 period behind. Hey, this Ichimoku thing need a little bit of research so that we can understand this thing. All right, the Sanko pan, it's an orange line. The fancy Sanko line is calculated by the averaging the Tekken Sin and the Kijuni Sin plotted on a 26 period ahead. Okay. Conversion base, the conversion and the baseline have purposely on the first day, they act as a support and a resistance during the trend, just like a moving average. Secondly, they provide a momentum information. They can tell you that there will be much more volatility when the price is trading above the 2 lines, and when the conversion line is above the baseline, it is significantly a bullish momentum. This is also very similar to the moving averages. When the shorter moving average crosses above the longer moving average, it means that the momentum is upper and rising. All right, guys. So I think for Ichimoku, we can hold on here so that we can be able, just a little bit of a demonstration, then we close. Maybe we'll do it on another day so that we can understand it, because it's a lot, so that we can understand it properly. So you go again on the Fibonacci. I mean, we go on an insert indicator. Under indicator, you look for Ichimoku. So there's a different indicators, as I said earlier. There's a trend indicator. There's a oscillators indicator, volume indicator, Bill Williams indicator, and a custom indicator. All right. So now, where is Ichimoku? Here's Ichimoku. You install, set. This is the base that we are talking about. This is the blue line and the red line, right? Now, what we're talking about, and a green line. When you see a green line passes above the blue line, you must know that it's a very bullish trend movement, right? You see this line, but you can't see it because the candlestick also they are green, but you can see it's going all the way, passes the baseline. The blue line is the baseline, go all the way pointing up. It actually means the trend, it's an upper trend. It's a buying instrument. When you see the red line goes all the way, passes the blue line down. So if this line is going to go and turn and pass this line, pushes down, it actually means the market has exhausted, it's turning, going on a bullish movement. You just understand 2 lines to pass 1 blue line. If a green line passes the blue line above, it means the bullish trend. If the red line passes the blue line below, it actually means it is a trend. So already you can look at it, look at this, it's not showing any type of a signal that it's exhausting of the trend, but by the time it's following other few candlesticks to confirm, you'll be able to see this turning, trying to pass. So the confirmation, it's when it breaks and pass it. That's where you can confirm a strong trend line. Look at here, the confirmation was when it breaks here to pass a little bit up, then you can know that the trend is continuing as a buy trend. So, all right, thank you very much for the time. I think also in the office, they are closing up everything, you know, for today. Yeah, any questions so far? For indicators that we check it out. Any questions so far? We good? Okay. If we good, then thanks a lot for the time. Maybe we do it again next week, Friday. We can finish up the indicator of Ichimoku just to make sure that, you know, we all in the same page. Okay, so thanks, Mr. Mokete. Thanks, Mr. Shavir, Spiso. Thank you. Thank you as well, Vivo 2015. Although you must edit it and put your name. All right. Next week, again, guys, let's do it again. Thanks a lot for your time. Bye. Sharp, sharp.